What's up everyone, it's Caddy with Money Investing. In this video we are going to be talking about one more technology related stock, but it's also in the medical sciences, so I consider this to be a little bit more biotech. Phenomenal company, high quality business. They are going to be reporting earnings next week, so I wanted to do a video on them today, go over the earnings expectations, go over the intrinsic value, go over the fundamentals of the business. What do they do? How well are they doing it? How well are they running the business? And of course, go over the technical analysis and my intrinsic value as well. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining us. Of course, getting access to all the buy and sell alerts, options alerts, trade ideas, members only videos that I actually posted one this yesterday, going over 4 trade ideas for the upcoming weeks. So again, if you want to get access to all that, link's going to be down below. There's also a 16% annual discount that we are giving out until the end of this month. So this company is going to be Agilient Technologies, and it is a global leader in life sciences, diagnostics, and applied chemical markets. They've actually performed really well since 2008, 2009. I think the stock's up like 1,700%. And the company provides laboratories worldwide with instruments, services, consumables, applications, and expertise, enabling customers to gain the insights they seek. So life sciences, diagnostics, and applied markets are some of the areas that they service. And these right here are going to be the products. So instruments, so Agilient offers a wide range of instruments for laboratory analysis, including gas that word is difficult, chromatographs, liquid chromatographs, and mass spectrometers, and microarray scanners, and services, consumables, and applications. The company's fundamentals have been absolutely phenomenal, which I'll go over in just a minute, but $1.37 is going to be that EPS estimate with $1.66 billion in revenue expectations, 14 downgrades in the last 90 days and 0 upgrades. But that's just the nature of the market. That's what we have seen for most companies because of the macroeconomics and of course the dynamics that we're in with respect to, of course, higher interest rates and the overall earnings declining on a year-over-year basis. The comps have been tough compared to last year, so a lot of the expectations have been lowered from analysts. Now, this right here is going to be that revenue growth, right? So 3.9 billion going to over 7 billion. So they have almost doubled, a little bit doubled, close to doubled in the last 9 years or something. And this right here is going to be that bar graph. Again, very, very nice, consistent growth here. Every single year, they've been able to grow the revenues. Gross profit going from 1.9 billion to over $3.8 billion. And of course, operating income has gone from $386 million to over $1.7 billion as well. This right here is going to be that net income, $734 million going to over $1.3 billion. And of course, shares outstanding have gone from 345 million down to under 300 million shares. EBITDA also moving in the right direction. It's gone from 758 million to $2 billion. So what do we have here? We've got a company growing revenues, growing earnings, growing net income, operating income, shares outstanding decreasing. That's exactly what we want to see. EBITDA is moving in the right direction, and free cash flow has also been growing, although at not that same rate. So this right here is going to be that financial summary, which I've started to include for most of our stock analysis videos. Gives you a good representation of what their CAGR is, right? The compounded annual growth rate for every company. So you'll notice the revenue has grown by a little bit over 2% since 2014, which is, again, nothing to write home about. But since 2018, more recently, they've been growing at a faster rate at 7%. Gross profit at 7%. But here's the kicker. Operating income, 13%. And net income at 34%, right? What does that tell you? That tells you they are becoming more and more efficient over time. So once again, if you take a look at net income here, they've gone from, since 2018, 316 million to over 1.3 billion dollars, whereas revenue has only gone from 4.9 billion to 7 billion dollars. So the growth rate is substantially higher for net income as it is for or compared to revenue, right? Free cash flow has grown by over 5%. Shares outstanding down 2% every single year, so they're buying back shares. And EPS is up 36% because, again, they're growing net income by 34%, buying back shares outstanding by 2%. So combined, that's a 36% compounded annual growth rate for earnings per share, which, again, is a very substantial number. It's considered as a growth stock. Free cash flow per share is up 7% on a compounded annual basis since 2018. Pretty good margins, so 54.5% gross profit margins, net margins at over 19%, free cash flow margins 12%. Pretty strong return on capital, equity, and assets here from the company. So very strong numbers there. And we've got balance sheet. That's the only concern, one of the only concerns. The other one's going to be valuation. So $1.2 billion of cash with a little under $2.9 billion of debt. So net debt's sitting at $1.7 billion. And of course, we've got pretty strong current ratio, quick ratio, debt to free cash flow is a little bit higher. But this right here, again, having more debt than cash on the balance sheet is one of the criterias that are not something that we look for, meaning that the company should have negative net debt. Right? I personally prefer companies with negative net debt because that gives me a little bit of that comfort that, okay, even if there's a lot of debt, the company has more than enough cash to cover that. But Agilent, unfortunately, doesn't. And that's the only concern that I may have, or hesitation I may have towards this stock. Now, when it comes to valuation, 23, 22 times earnings multiple is where we're at. And we are also price to sales a little bit over 5 to 6. We've got price to cash flow at 24 to 25. And enterprise value to EBITDA trading at just over 18 to 19 levels for the company at the moment. So valuation is reasonable for what we have seen in terms of growth over the last 5 years. But when it comes to the future growth, the expectations are not that high. It's only 8.6% growth here expected from the company from 2023 to 2027, going from 560 to 779. That's an about 8.6% growth here for the business, and shares outstanding obviously going down by 1.6%. So that's where the growth expectations are for the next 4 years. If you plug in, say, a 8% growth here for Agilent, a 14 times P multiple, which obviously is going to be a little bit lower than where it's trading at the moment, substantially lower, 11% discount rate because they do pay out, I think, a little bit under 1% dividend yield, 10% margin of safety, the same amount of shares outstanding going down every single year. We come down to a fair value closer to $66, and obviously right now it's trading at about $126 per share, which does represent about a 47% downside needed in order for this stock to be trading at its intrinsic value. Now, again, these are not set in stone. Things are subject to change every single day. In fact, every single minute, because there's new information coming out every single minute, every single second of the day. So these are not set in stone, but instead just values that you can use as a framework, and of course do your analysis on top of that to see where you see the fair value to be for every single company that we analyze, right? For Agilent, you may have a different fair value. For every company, you may have a different analysis and a different intrinsic value for that stock. But this is just my estimates. And as you guys already know, that I like to be super conservative and I want to go in with a margin of safety, with a room of error, that if things don't go according to plan, if things don't work out as planned, at least we have some room of error. At least we have some margin of safety to protect us from potential downside. So that's exactly one of the reasons why I go with a margin of safety. I go with a lower growth rate. I'll go with a lower multiple, and of course a discount rate that's fair enough for us to actually take advantage of that opportunity in the first place, right? Because if it's not worth the risk, then why take the risk in the first place, right? It has to be worth our risk, right? The return has to be worth the risk. This right here is going to be that sensitivity grid. And again, right now, since it's trading at $126, we are going to be around here, 20 times P multiple, which is exactly where the market's right now. And of course, a 14% growth rate is what Agilent is expected to achieve for the next 5 years to basically justify its value at close to 125, 126 today. Which is it impossible? No, of course Agilent can achieve that 14% growth rate. We already know that they've been able to do over 30% in the last 5 years. But again, it's just that having that best case scenario, and of course having a bear case scenario and then a reasonable scenario. And in my opinion, I think having that 20-25% growth rate, even 14%, kind of falls a little bit more on the optimistic side, a little bit more on the best case scenario type situation. And I like to be a little bit more neutral, more reasonable, and go with a pessimistic scenario. And if it plays out, perfect. If it doesn't, at least I'm pricing in for the worst case scenario anyway. So that's going to be the analysis for Agilent. I think it's a phenomenal company. And stock price wise, we are making a little bit of a descending triangle. Let me just point that out. So this is going to be a huge support for Agilent at about $112. And this right here is going to be the lower highs, which is constantly making it, getting rejected at those levels. So I wouldn't be surprised if after the earnings, we do see maybe a little bit of a rally back higher up to that resistance, getting up to 146, 145, and then selling right back down to 115. That right there is going to be that descending triangle. And as we continue to kind of coil inside this pattern, that of course wouldn't be surprising to me if you do see a little bit of reset in valuation because of the 22, 25 times P multiple that it's trading at, even though the consensus expectations for earnings is a little bit under 10%. So that's going to be analysis for Agilient Technologies. Let me know your thoughts down in the comment section below. Obviously, it's performed really well. It continues to trade above its moving averages. It is up on the year, so up a little bit over. Actually, it's down. It's down 16.5% on the year. So it's definitely underperforming the market and, of course, its peers year to date. But some of those moving averages are going to be very important to watch. $103. And of course, down to those pandemic lows is where my fair value is going to be for Agilient. But again, these are not set in stone. I'm a lot more flexible, in the 70s and the 80s. Some of those levels also, I would be willing to take advantage of that as well. So like I said, there's a flexibility range, right? Plus minus 5%. But of course, the balance sheet is a little bit concerning. So that's something that we may need to watch on a constant basis. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. We'd love to have you on board. You get access to all the binds alerts, options alerts, trade ideas, members only private videos. Everything's going to be included. So as always, happy investing, and I'll see you all in the next video.